with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 2nd, 2025. Some shout outs to Ed, Rachel, Mike, Tim, and Ray, and so many other folks, and all the love we're getting on social media. Thank you all so much for chiming in and showing us so much support. We appreciate you all so much. So, what about Mr. Stock Market this week? Well, Mr. Market had a pretty good week this week. As expected, we thought things would push higher, and they did. Dow Jones up 3% on the week, S&P 500 up 2.9%, NASDAQ Composite up 3.4%, and the Russell Small Cap Index up 3.2% on the week. So all the major indices pushing higher, a lot of strength there in the market this week. The volatility index, as you might expect, down a bit, down 8.5%, still at 22.6, can kind of break either way. We'll be watching to see what happens there. And long-term bonds, as measured by the TLT, they dropped this week, down 1.3%. That means rates went higher again. Rates continue to be sticky. Right now, the market's looking past that. It doesn't seem to care a whole lot. That's something that's interesting. This 10-year bond just hanging in there, hanging pretty tough. When we look at the sectors of the market, the defensive areas were the weakest, as you might expect. Consumer staples, they were only up 0.9. Energy was down 0.5%. Healthcare only up 0.3. Everything else was like up between 3 and 4%. Well, outside utilities, they were only up 2%. They tend to be defensive, but these days, with all the data centers and artificial intelligence and all the need for juice out there for electricity, utilities have been kind of strong, but still weaker than the rest of the market. So defensive, underperforming, everything else doing really well this week. And then looking at the metals, gold, hey, you heard it here first. Gold down 2.2% this week. Look, we talked about that last week. The charts didn't look good for gold. We thought, it had a blow off top. It was probably headed lower. So we trimmed back our gold holding, Kinross Gold mining company we have in a lot of our larger models. We trimmed that back substantially last week, and gold really started to roll over this week. I think it has lower to go. I think it will continue to press down a bit further. It'll probably land somewhere between $3,000 and $2,800 an ounce. But I like what we were sitting here with Kinross. It's still a great company. We've trimmed back some profit, so we'll just hold what we have. So metal's not doing so good. Silver was down 3% this week as well. So what's moving markets this week? Well, tariffs, number one. Number one is tariffs. I would say even more so than earnings, those tariff announcements. Like earlier this week, we had some reports that there are some deals that are really close to being announced with some countries. So market responded positively to that. Then President Trump rolled back some automotive tariffs. Market liked that a whole lot. And then the big one, which happened Thursday night into Friday, China actually took a step towards the negotiating table. Of course, they had a lot of caveats attached to it and some really big caveats attached to it. But nonetheless, they made a step towards the negotiating table, and the market responded very positively to that news. As a matter of fact, half of this week's returns happened today here on Friday. The S&P was up 1.5% just today. So market really liked that quite a bit. In addition to the tariff news, we've had earnings. Earnings have been better than expected, and guidance, I think, has been better than expected because, you are getting some guidance. Some companies are actually maintaining guidance. Now, others are doing two scenario type things, and others are pulling it all together. The market kind of expected that to happen, but I think the market's getting a lot more data from these companies than it expected. Earnings have been pretty good. What I would caution all of us, though, on that is this. There's been a lot of front-running the tariffs. Look, we had a huge trade imbalance. We actually said, a month and a half ago that we were probably going to have a negative GDP quarter because of the trade imbalance. But guess what? This past week, it was announced GDP was negative last quarter. We thought that was going to happen, specifically because of trade imbalances, because of all the front running of tariffs. So a lot of this is reflecting, I think, in the numbers of these companies. And the question is, what type of impact is that going to have on the next quarter or the one thereafter if everybody's so overstocked ahead of the tariffs? Well, we'll have to see how that shakes out. Now, one of the bright spots I'll say about earnings is that the earnings revisions, they're still dropping, okay? But now that we've had a lot of other companies report, they're not dropping by as much as they have dropped the last couple of quarters. The rate of change is diminishing. We've talked about that in the past. That is something the market tends to respond to. So that could be a good sign. We'll be watching that as we move forward. We also had a lot of economic data. I think I mentioned the PCE was cooler, that inflation number, the market like that. The March pending home sales, that was the strongest number since 2023. So everyone's out wanting to buy houses all of a sudden. Market like to hear that. We had the jobs number for April was super strong. I say super strong, much stronger than anticipated, much stronger than expected by quite a bit. Some of those jobs are interesting, though. Some of those jobs related to imports, warehouses, things like that. It makes you kind of scratch your head and wonder if some of this front running didn't add to some of those jobs as well. On the negative side, I mentioned the negative GDP number came as no surprise to us. We said that was probably going to happen. But then on top of that, the continuing jobless claims and the initial jobless claims, they were not so hot. They were weaker than expected, and that's not a good thing. They tend to lead the bigger jobs number, and folks are really trying to stay ahead of the curve. They tend to watch that one. They tend to watch these initial and continuing jobless claims more than anything else, and they weren't so hot this week. So those are things to be mindful of as we move forward. Everything else, I mean, it kind of boils down to levels and technicals, honestly. We're having a lot more earnings still coming out next week. We got the Federal Reserve's going to have their monthly meeting next week. My guess is they're going to hold steady. I don't think they're going to raise or cut. That said, they may alter some language. We'll have to see what happens there. I mean, given some of the data, I'm not sure they will. They're probably going to project that they're going to stay put for a while. We'll have to see how that comes together next week. The market's going to be listening very closely to that. And the market's going to be watching all these additional earnings coming out as well. So what should we expect moving forward? Is it all over? I think not. I don't think it's all over. Look, I mentioned to you over the last couple of weeks that the market needed to clear that 50-day moving average. It's right around 5,600 and change. It did that this week. That was the first hurdle. But the second one that I'm watching that is more important is just above the 200-day moving average, right? 5783 on the S&P 500. I think that's the level that I'm really keying in on there. I think the market probably wants to make a run towards that. It's a couple percent away, so you got about another 2% higher from here. And I do think the market wants to make a run towards that level. Looking at the technical indicators, the DeMark, right? We talk about Tom DeMark's work, the 9s and the 13 countdowns. We're closing in on a 9 on the upside, saying that this big move in the market is getting close to exhaustion. And look, the S&P oscillator, another thing that we watch pretty closely. When it gets over 5, watch out. The market could be getting exhausted and the move could come to an end. And right now it's 6 point something, almost 7 on the S&P oscillator. So there are some things that tell me that in the super short term, the next week or two, the market's probably going to try to push up to that 5780 or so. But I think the odds are very, very high it fails there. I think a lot of damage was done with that decline we had a few weeks ago. I say a few weeks ago. It started in January. It climaxed a few weeks ago. I think a lot of damage has been done. And traditionally, the market tries to retest a low before we get the all clear. It does it so often, it's so common that it should just be expected. And you should err to the side of the equation that says the market is going to go back down. It is going to do some sort of retest. Err to that side versus the side where the odds are so very low and minimal that we're just going to keep on going higher and never look back again. I just think the odds are really against that at the moment. So I think we're probably going to get a little higher here, probably then roll over, head lower. And we're going to be looking to buy that very aggressively. We really are. When you just take all of the information out there and you put it all together, I think the odds, the probabilities are much stronger for this market to go higher and by quite a bit, looking out 12 to 18 months from right now, okay? I think the odds are very, very high. The probabilities are very, very high. Just given the data, we've had sentiment numbers that were just completely blown out of the water. You only see them at bottoms of markets. We had breadth indicators that we've only seen at bottoms of markets. And then you look at the 200-week moving average. We've talked about that. We got pretty close to it. We didn't break it. Even if we have a recession, which I still think is a high possibility that we do slip into a recession. Look, we just got one negative quarter of GDP. If you get another one with some weaker jobs, the Bureau of Economic Research might actually call it a recession. We'll have to see what happens. But even if we get it, I think the downside to this market is limited. I really do, because a lot of this stuff is man-made, and I think it's going to settle out, and the market's going to start soon looking at 2026 earnings, not 2025. When it starts looking at 2026 earnings, it's going to start pricing that in, and I think it's going to be a lot more constructive longer term. So if we get this rollover, if the market fails and starts to head lower, we are going to be looking to buy that very aggressively and get situated for the next 12 to 24 to 36 months. You're moving much further ahead from the here and now, because I think the market is going to go quite a bit higher over the longer term. So maybe a little higher in the short, a little higher in the long, a little sloppy in the middle. And we'll look to jump in there and buy that if that happens. What if it doesn't happen, David? What if you just missed out on this big move in the market? Well, first of all, we didn't miss out. We bought a whole bunch of stuff the week that the market hit its lows. Monday, Tuesday, and Wednesday morning of that week, we bought a whole bunch of stuff. Well, we are still sitting on some cash, but here's the thing. There's an investment I could buy right now. I love it. It's not correlated to the market. It's at a great price point. I got no problem moving into that. There's all types of other things I've got my eyes on, individual companies that look really attractive. So there's always something to do. No worries about that at all. So if we cross that hurdle and we hold it, then that does look like an all clear, and we will adjust accordingly. What we try to do, folks, is not insist that we're right all the time, because that is a loser's game. When you sit there and you dig in and you insist that your opinion is going to come to fruition, you'll lose money. You just lose money. That's not the game we play here, right? We're not doing that. I don't want to be right. I want to make you money. Okay? Seriously. I want to make you money. So we're going to stick to a thesis until the data tells us otherwise, and then we'll switch gears, and we'll switch gears quickly. But I think we do a pretty good job of staying ahead where this market usually likes to go. And so far, year to date, that is reflecting in your numbers. Hopefully, you've been enjoying that. So I'm going to wrap up, all right? But between now and next you meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Get that nice retirement, get it in a little earlier than expected. Hey, maybe you want to be that rich aunt or uncle that just leaves a legacy to all these nephews and nieces that were like, oh, aunt who? Oh, wow. How awesome is that? Maybe it's charity that you're focused on. Look, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.